Okay, how's the sound out in Zoom land? You guys can hear me pretty clearly? You can just like thumbs up, I can see you. So thumbs up, thumbs down, can't hear me? Yeah, okay, good. All right, so we're still in chapter 1, and we left off talking about financials. Yeah, we were still talking about financial statements and kind of moved on to talking about what is a business. So what is a business? And the first thing we said, well, we can talk about some things that businesses do so that we can understand what a business is, right? And so first things first, a business has to get its resources from somewhere. And so generally speaking, we say the business gets its resources from the market. I'll put it in scare quotes, because the market can mean a lot of different things. It can mean a lot of different resources, a lot of different sources. One of the most obvious ones is you can just, Linnea can say, I want to start a business, and she can go to her bank account and take out money, right, and buy the equipment or whatever. Like, that's one way that she can start her business by getting the resources of financing, right? And so her doing it herself is still kind of part of the market, right? Because she is part of the market. She could also go to a commercial lender. And I was talking last time about the difference between commercial banking and retail banking. You should kind of, it's not really testable, but these are the things you should, the vocabulary that you're going to want to have when you go out into the business world, right? So she can go to a commercial lender, right? So usually it may be the same, your town, your hometown bank typically has both commercial lending and retail lending. It's just different people in the same building. Okay, so she would go to a commercial banker and say, I want to start, a pizza shop, or I want to start, something, right? And she would get a loan for however much money from a commercial banker. Other ways that she could get money is she could go to the equity markets, and we'll talk more about that later. She could sell, right? She could sell a portion of her business to other investors. So Linnea could go to Caitlin and Amanda and say, hey, I'm starting a business. Would you guys like to be part owners? And then you can contribute money to my business and be equity holders, right? Equity means just ownership. Okay, so you could be a equity holder in so that's another way. So they essentially own stock. And we'll get into that in chapter 4 a lot more. Okay, so those are kind of some of the ways that she could initially get her financing to start her business. Next, now that she's got the money, she's going to buy property, plant, and equipment. Or we'll call it PPE. Right? Not personal protective equipment, but property, plant, equipment. In this case, so that would be things like a building, right? So she's going to run her business, got to be someplace. Maybe she's going to need some equipment. So if she's running, easy example, if she's going to say, I'm going to start, Linea's Pizza, then she's going to need a building. She's going to need ovens. She's going to need, mixing equipment and all that, right? Refrigerators, right? So that's examples of equipment. So property, plant. Plant usually refers to a building, physical, like spaces. Property is all the stuff you put inside your physical plant. Right? You're going to hear that phrase a lot. The physical plant of a hospital is the 4 walls of the hospital, right? The property is all your stuff inside the building, typically. Equipment, another word for property, other kinds of word for property. So I will use the phrase PPE a lot. So you should kind of get used to it. When you hear me say PPE, I'm talking about physical stuff, right? The physical stuff that a business uses, whether that's the land, the building, the stuff inside the building. Okay, so when I say PPE, you should think physical stuff that you can touch. Okay? So she's going to buy that stuff with the money that she got in step 1, obtaining financing from the market. Then she's going to operate the property to create goods and services. Right, so she's bought the oven, she's rented the space, she's bought the ovens, she's bought the equipment to make her pizzas, and she is now going to operate all that stuff, making pizzas and selling them to hungry college students, right? So she's going to be running her business very successfully, and she is going to sell goods and services. In this case, mostly we'd say goods, as we're talking about pizza, to create revenue. And so she's going to sell the stuff. So she's kind of 4 steps, right? She got financing to buy the stuff that she's going to use to make the pizza that she's going to sell, right? And then she sells the pizza to make revenues. So it's kind of this, and this is a kind of a circular, right? So you get the money, right? You get the stuff, you make the pizzas, right? And then you sell the pizzas to the hungry college students who are coming from a long night at sports, right? And you got money, and it keeps going around like that, right? So now you have the money, right? And it becomes, if you have a successful business, you don't have to keep going back to step 1 to get money from the market, because you are getting revenues coming in to support your business, right? So you have, at that point, a going concern, meaning that it is going to keep on going in a circle like that, self-supporting. It doesn't have to keep coming back to the market to get more resources. It's generating its own resources. So there's a couple of points we want to make here and clarify. Government agencies versus business, right? One of the big things, the difference between a government agency and a business is, government agencies are funded through tax revenues. Typically, there are some revenue-based government agencies, but for the most part, government agencies are funded through taxes. And very often the accounting in government agencies is very different. Right, from business. And we're not going to do government accounting in this class, but it looks different. There are different rules and processes for government accounting. Okay, now, and we're just really not going to talk much about government in this class at all, other than as a setter of policy and rules, right, for the overall market where our businesses that we are going to talk about operate. So government helps set the rules of the game that the businesses in the marketplace have to obey in order to stay in business, right? So government, so when Linnea goes to create her business, she has to interact in some way with the government so that the government acknowledges the business's existence, particularly if she wants to incorporate. We're going to talk about that in just a second. So business now versus what we call pure charity. A business sustains itself primarily through selling goods and services, whereas a charity, a pure charity, sustains itself through donations. So a pure charity, and we want to emphasize pure charity. So think of the American Cancer Association, right? 99% of their revenues come from them asking you to give them money, right? And maybe you give them money because you had a loved one that had cancer, or you worry about yourself getting cancer, or you just have a general sense that funding cancer research is really important and you're going to give money to them. Basically, they just go out, they ask for money, you give them money. That's how they fund themselves. Businesses, Linnea has to convince you that she makes really good pizza, that it's better than Wildcat Pizza, it's better than Village Pizza, it's better than T-Hop. right? In order for her to get her money, she's got to sell pizza to somebody, right? So she competes with all the other pizza businesses in Durham in order to get her goods and services. Charities also compete, right? So there's how many of you have gotten, requests from the Cancer Society, from the Children's Hospital, from, the Save the Whales, and, and so on, right? Charities compete too, right? But they're competing in a different way, right? So on the one, businesses compete by trying to convince you that their product or service is really good. Pure charities compete by trying to convince you that their cause is more important than the other causes. Not that the other causes aren't important, but just that you really want to get to their cause, right? So when you graduate, UNH will come and say, well, don't you want to give to us? Right? And UNH is not a pure charity, right? So first of all, it's technically a government entity. Second of all, it's not a pure charity. It brings in revenues, all the tuition that you guys pay, right? The tuition and fees that you guys pay, right? So it's not, but it also takes in money through charitable donations, and you'll get lots and lots of messages from UNH when you become a right? So we have, so in the healthcare market, right? So pure charities are typically, you will hear the phrase 501c3, right? They are 501c3 organizations. 501c3 organizations, 501c3 refers to an IRS regulation, like that 501c3, it defines a charitable entity. Okay, so all your pure charities, like I have the example of the American Cancer Society, Save the Whales, whatever, are 501c3s, but so are hospitals. Okay, so the difference between so it's not, so we want to think about 501c3, right, refers to a charitable entity, but it doesn't necessarily mean that it is a pure charity. So all pure charities are 501c3, but also many, but not all, nonprofit revenue generating entities, right, are also 501c3. So Wentworth Douglas Hospital down the street in Dover is a 501c3. Right? It is a charitable entity. Not all and it is also a nonprofit. You will also hear the phrase not for profit. And I will kind of flip back and forth in my banter here and say not for profit, nonprofit. It's the same thing. It's just a slightly different way of saying the same thing. So don't get hung up like, okay, it's a nonprofit for this entity and a not-for-profit. They're different. They're not different. It's just me stumbling on my right. And you'll hear and you'll see it in writing both ways. Right. And they're both right and they're both the same thing. Right? So don't get confused on that. So a hospital is a charitable organization. It is a nonprofit charitable organization. You can give money. Trust me, Wentworth Douglas will ask you for it. So will Mass Gen, and so will whatever other, all the other local hospitals. They will ask you for money once they find out, your address. You'll get regular, letters from them saying, "Don't you look at all the great things you're doing for the community? Don't you want to give us some money?" So they are not-for-profits, but they are revenue-generating entities. So they have a mix of, they take in some donations, but primarily hospitals, not all hospitals. There's always going to be kind of an exception to what I'm saying to you. So children's hospitals, so for example, Shriners in Boston operates mostly on charitable giving, not on fee-for-service, right, or charging for revenue generating, right? They're primarily not-for-profit, primarily donative is the formal name, donative. Refers to what our book calls, our book doesn't use that phrase, but it's probably a little more formal. Pure charity, what our book means is it's primarily a donative organization, primarily gets its resources from donations. Yes?
Typically going to get the bigger hospitals that can offer elective surgeries that are the revenue generating.
Say it again, the first part of it.
It's typically like the bigger hospitals that can do elective surgery as well as the charitable surgery or donative surgeries that are revenue generating.
Yeah, so so I would say 99% of hospitals are revenue generating. They do fee for service and or some other method of charging you, the patient, for their services. So the vast majority of hospitals are not donative organizations. So there's kind of this small subset, particularly of children's hospitals, that are primarily donative. But most hospitals that, pretty much you can assume in this class, when we talk about a hospital, you can assume that they are charging for services and that's their primary method of getting their revenues. Okay, so for this class, we will focus on revenue generating organizations. Hospitals like Wentworth Douglas gets 99% of its revenues from the services that from charging for the services that it delivers. Okay. And those hospitals that are donative actually can do quite advanced stuff. They're not just now. The other thing is, we'll talk about this. Community hospitals do a portion of their business where or their care where they're not reimbursed, and we wind up calling that charitable care.
The hospital does like research work, or they can also get money from government.
Absolutely. So the question was, can a hospital get money from government if they're doing research? Yes. So we have, typically when we're thinking about research, we're going to be thinking about academic medical centers. And we'll kind of talk a little bit about that. So we have in New Hampshire, we have Dartmouth-Hitchcock is an academic medical center. They do a lot of research. They have a medical school. So typically when you think of an academic medical center, it has a medical school attached to it or they are affiliated with one. So down in Boston, you've got Mass Gen and Boston Children's and Mass Eye. The whole partner system is affiliated with the Harvard Medical School, right? And they do tons of research. And in fact, with an academic medical center, very often the money coming in from research is it competes with, contributes almost as much to their revenue stream as does the fee-for-service portions. If you talk to physicians that work in that system, if you're a physician that's really into research, and you're in an academic medical center, you actually get a little bit higher up, a little higher in the hierarchy than if you're just like, hey, I just want to see patients. So a lot of times the physicians that are like at Mass Gen, they're like, you know what, I don't really want to do research, kind of get pushed out of the organization over time.
But that one is like harder, but like Harvard Medical School or whatever, is money now coming also from the endowment, or is Harvard not contributing money to that, or is mostly just coming from the hospital?
Yeah, so the question was, so if they're affiliated with Harvard Medical School, does the Harvard endowment provide funds to the hospitals? You're getting into detail that I don't know the answer to, but my guess would be no. Hospitals is a totally separate entity. They have an affiliation with Dartmouth. Harvard, in that case, Harvard, right? Dartmouth, same thing. But they have an affiliation with Harvard. So Mass Gen has an affiliation with Harvard. The Harvard endowment, even though it is enormous, bigger than the GDP of probably half the countries in the world, it is not funding medical care, as far as I know. I could be wrong on that, but it would be, if it is contributing, it would be a very, very small amount. Most of the research money actually comes from the federal government. And so we're getting a little bit of a rabbit hole here, but here at UNH, a lot of your professors, particularly if you take any of the science classes, will go out to the National Science Foundation, the National Institutes for Health, right? And we compete for grant funding, and that's kind of what that is the majority of academic research funding comes from those kind of big government entities. You can also go to private entities. So there are foundations that were created to do research on particular things. So maybe you really care about heart disease and you become a rich gazillionaire someday. You create a foundation for research on heart disease. People would then compete. Researchers would then compete for funds from you. They would use that to do their research at, say, MassGen. Does that make sense? Okay. So, yeah.
Sorry, can I just ask a question? Sorry.
Yeah.
So using the Wentworth Douglas example, although they still are revenue generating, they're still considered a nonprofit just because of the way their business structure is set up.
Yes. So okay. So they are a not-for-profit entity. So let me just put a pin in that for a second, and I will come back to that because we're going to talk about the difference between investor-owned entities and not-for-profit entities just in a couple of minutes. Okay. So I will come back to that, I promise, and we'll make a big fuss about it. All right. So, but let me keep going on this idea. So you should remember that being a charity means you have to be a not-for-profit, but it doesn't mean, but not all not-for-profits are pure charities. Hospitals are a great example of not being a pure charity. They get some charity, they get some money from donations, so they're partially donative, but they are mostly funded by selling goods and services. Okay? And then we have for-profit hospitals and not-for-profit hospitals. So up the street from us, so we have Wentworth Douglas, not-for-profit, Exeter, not-for-profit, right? Catholic Medical Center, if you're from Manchester, Elliott, those are all not-for-profit entities. Portsmouth Regional, Frisbee, Parkland are all owned by HCA. We talked about, I showed you their financial statements last time. HCA is a for-profit entity, so you have examples of hospitals that are for-profit entities and hospitals that are not-for-profit entities. We'll talk about what that means in a couple of minutes. Okay, so putting aside that for a moment, we will come back to the idea of not-for-profits and for-profits. Businesses are generally formed in I'm going to talk about three broad categories. There's a lot of detail that I'm not going to get into because it's not appropriate for this level of class, but I will briefly mention some of the other forms of business. If you actually were to start a business, you may want to investigate. If your parents run businesses, they may have a different form than one of these, but these are kind of the three most generic forms. So the business forms, right, the three principal business forms. The first one is sole proprietor or sole proprietorship. Right, this is a business owned by one person or one individual. So going back to Linnea, the example with Linnea's pizza shop, Linnea could say, I want to start Linnea's Pizza, and she just goes out, rents some space, buys some equipment, gets Amanda and Lauren to help her, put the thing together, hires them as her staff, and starts her business. If you want to be a sole proprietor, from the government's perspective, you typically have to the only thing you really have to do is register your business's name if you're going to do it as something like, Lydia's going to start it as Wicked Good Pizza. You might have to go register the name with, depending on county, maybe go to the county courthouse. You pay a small fee, right? They do a name search to make sure that there isn't another Wicked Good Pizza in town, right? And then pay them $25 and you're a business.
Registration is considered licensing.
So yeah.
Not considered licensing.
Is that considered licensing? No. So you're really just you're registering the name. There isn't what I'm describing is not a license process. There could be licensing processes depending on what you're doing, right? So some businesses do require licensing. So if Linnea was going to start, instead of starting a pizza shop, she was going to start selling nuclear medicine supplies, she would have to go out and get a license from the Department of Energy, the Department of Energy, right? So you have to get a federal license from the Department of Energy saying, yes, you can handle nuclear supplies. But if she's going to make pizza, no, there's no licensing process. If you're going to start a nursing home, there's a licensing process, right? But the most simple thing, if you're getting into a business does not require a state licensure process. Good question, actually. Good, particularly since we're talking healthcare. Most healthcare organizations, you do have to get a license of some sort, right? So if you're going to be an assisted living facility, if you're going to be a nursing home, hospital, obviously, you're going to have to go through a process of getting licensed. But if you're going to sell pizza, you don't have to get licensed. If you're going to sell durable medical equipment, you don't need to get a license, right? If you're going to be a healthcare consultant, you don't need to get a license. If you're going to be a healthcare consultant, right? So if Amanda decides she wants to be a healthcare consultant, all she has to do is hang out a shingle, figuratively, she's create a website, Amanda's Consulting, and she's in business as a sole proprietor, right? So the advantages of being a sole proprietor, it is the simplest form of business, right? So the advantage is it's simple, simplest form, right? Basically, you just start selling stuff. So if Amanda's going to start, her own consulting business, she just puts up a website, starts making phone calls, to Lauren, the CEO of the local hospital, and says, "Hey, Lauren, remember me from back when we were at UNH together? Now that you're CEO, I've started my own consulting firm. Do you have any problems that maybe you could use an outside set of eyes to look at?" Lauren says, "That's fabulous. I'd be more than happy to pay you your $500 an hour rate because we're old friends." Right, and then Amanda is in business, right? So she just starts selling stuff. I mentioned you might need to register, or depending, maybe get a license depending on what it is you're doing, and or what it is you're selling, right? So if you're selling, nuclear materials, radioactive materials, you're going to need to get a license. If you're going to start a nursing home, you're going to need to get a different kind of license, right? You may need to register, like I said, about like registering a name. Those are pretty simple. When I was in my 20s, I started a little retail mail order business. I was kind of unsatisfied with my work, and I was like, I'll try this thing. And it was a lot of fun. I lost a whole bunch of money in the process. And this was pre-internet, so you couldn't just create a website. You had to make a physical catalog and mail it to people that didn't want it, most of it, right? And so lost a bunch of money, but learned a bunch of things like how you go about registering a business, right? So I actually did that. I went down, it was in El Paso at the time, and I went down to the El Paso, courthouse, and I registered my business and, paid my $25 and stuff. And I just was in business, right? And I started selling stuff. Didn't sell a lot of stuff, so the business folded, but that's, a whole other point. And part of why here I am today, instead of being, a multi-millionaire. Let's see. The key problems, right, or it's both it's kind of a two-sided coin, right, in sole proprietorship, because there is no difference between the business and the owner. Okay? So the benefit of this is that it's really simple to set up. From the government's perspective, if Amanda hangs out Amanda Consulting, right, as far as the government is concerned, that's just Amanda doing stuff. And that is pretty much, as a sole proprietor, that's basically all you're doing, right? You hang out that shingle and you start doing stuff as a business. And you'll see this, you'll actually see when you get into this, when you start dealing with businesses, you will see some stuff like, for example, Amanda, right, doing business as DBA, doing business as Amanda's Consulting. And you'll see that, like, for example, on her bank account, when she sets up she'll hopefully set up a separate bank account for her business, separate from her personal. But from the government's perspective, it's all the same. So the advantages here are, it's really easy. She just files a Schedule C on her personal tax return, right? So the business, so from a tax perspective, right, files what's called a Schedule C. On personal tax return. So if Amanda makes $100,000 this year as a consultant, right, that just becomes regular income to her. Right? It's called ordinary income. Ordinary income. So Amanda, yes, sir.
Are taxes that much higher for a partnership or corporation?
So let me answer that when I get to it, okay? And I'll explain it. There are differences. But what I want you to get right now is the profits that she makes from her business, from the profits Amanda makes from her consulting business are treated just like if she had a job, right? And she was making, if she makes $100,000 in profit from her consulting business, it would be treated just like if she had a job working as a consultant for McKinsey or one of the big firms making $100,000. Does that make sense? So then she would pay whatever her personal tax rate is for $100,000 a year. And it would just be treated, it would be mixed in with all her other income that she made this year. So maybe she was doing this on the side and had a job, doing something, working for a hospital or something like that. So it would just be all added together and it would just be treated as what we call ordinary income. Because there's no difference between the, so this is a benefit, right? It's relatively simple to do the tax return. It's very easy to, so the big advantages are it's easy to set it up, right? So it's easy to set up. Pluses, right? Easy to set up. Gains and losses are treated as personal income, right? And there's a phrase I'm going to get to in a minute, Cole, right? Yeah. Okay, so Cole brought up the question, about the difference between proprietorship and corporation. We're going to talk about double taxation in a minute, but there's no double taxation. I'll come back to what that means in a minute, but you want to remember that there is no double taxation. The big downside. So now we got the, let's say, the cons. Unlimited liability. So what does that mean? So Linnea starts her pizza business and she hires Aaron to as an employee, and Aaron is out driving, dropping off pizzas over at the cottages. And Aaron, as she's driving down the street, Aaron gets a text from Tessa, right? And she picks up her cell phone and is like, "Oh man, Tessa's sending a really cute selfie." And Aaron's like, "Oh, that's so cute, Tessa." And she's texting, and then she runs into a car in front of her, right? And crashes Linnea's delivery car while she's out delivering pizzas for Linnea, right? Linnea, as the employer, is now liable for the actions of Aaron, right? So let's say, Aaron didn't just hit me driving around town in my 16-year-old minivan, but say, Cole in his brand new $100,000 Tesla, not Tesla, a Tesla, right? So he's driving around in his brand new $100,000 Tesla, and it gets totaled, right? So now Linnea is on the hook for a $100,000 $100,000, right? Assuming Cole is incurred, and if he is, she's on the hook for that too, right? So maybe Cole gets some whiplash and he winds up suing, Linnea for that as well, right? So now she's maybe on the hook for $200,000. The problem here is this is where unlimited liability comes in, right? First, the courts will award Cole whatever value the business is. So let's say Linnea's Pizza is worth $100,000. The total damage that Aaron did was $200,000. So first they take the business and liquidate it, and they get $100,000. Well, there's still a $100,000 delta there, right? There's a difference between, right? So we paid $100,000 towards Cole's losses. There's another $100,000 that needs to be paid. Because there's no difference between Linnea and Linnea's Pizza, they now go after Linnea's personal assets. So Linnea has a cute house, out in, overlooking Great Bay. They come and they take that and sell it and to get the other $100,000. So there is no shield protecting you as a sole proprietor from major losses. There is no difference between you and the business. So if you have a business-related loss or liability, right, that exceeds the value of the business, then the creditor or the claimant can come after not only your business assets, but your personal assets as well.
So Linnea was actually a billionaire before she started her pizza company.
Yeah.
And she has that money in her personal account.
Right.
Since there's no difference, let's say the pizza thing is a hobby, does she pay out-of-pocket damages and keep the business open? Okay, so Linnea, you're a billionaire, as it turns out, and you're just doing the pizza place as a hobby. And the question was, can they come after your personal? But you choose to just pay out-of-pocket instead of, and then keep the business open.
And keep the business open. So the question was, do they have to take the business from you if Aaron crashes the car? No, the answer is you can pay it. You can just write a check. Because you're a billionaire, you can just write a check to pay it off. But the way that this would work is, because it was a business-related liability, they would first come after the business. But again, because there's no difference between you and the business, they're going to come after you and your personal assets when there's no more assets in the business, right? But if you're a billionaire and you'd be like, hey, really sorry about that, Cole. Here's $200,000. You know what? Here's $250. Go get yourself some nice coffee as well, right? So, and Linnea is like that, being a billionaire. Okay, so, but this is a big one, like real world wisdom.
So can you get insurance, that you can get your own insurance, and you can get insurance for her business, like as a customer, like, because it's customer and she get the insurance.
Yes, so hopefully, so hopefully she would have, obviously she would have auto insurance on her, and she would have business insurance, so she could protect herself using insurance. Yes, good point. And since she's very smart, as we all know, she would probably have plenty of insurance to cover her, cover for accidents like this. But if you wind up, so in a very extreme kind of example, if you wind up having a liability that goes beyond the value of your insurance, right? So let's say instead of wrecking, just wrecking Cole's car, Aaron, hits Cole so hard that he winds up as a paraplegic, and Linnea's got $300,000 in liability insurance on her auto, but Cole gets a $10 million settlement against her. Right? Wait that, the insurance company will pay out the 300, and then the $9,700,000 delta all comes out of Linnea's pocket. Right? Okay. So yes, you would get insurance. If you're running a business and you're responsible, you would get insurance. But as a sole proprietor, if you wind up with a liability that exceeds the value of your insurance and it exceeds the value of your business, there is no difference between you and the business. And so your personal assets are liable for any loss. Does that make sense, Devin? Okay. All right. So unlimited liability is the big, scary kind of bugaboo of doing sole proprietorship. Yes.
Would there ever be any situation where you could have like some sort of insurance that like separates you and the business for the purpose that you expect something like
So if you are concerned about liability, you would incorporate. And then you can separate yourself from the business. So we'll talk about corporations in just a second. So that is the big advantage of a corporation, is there is limited liability. So we'll get to that in just a second. Okay. The other problem with sole proprietorship, so another con, is limited life. So the business and Linnea are the same. If Linnea gets run over by a bus, which we're not hoping will happen, but if it does happen, then the business ceases to exist as an entity, because Linnea is the business and the business is Linnea. Right? So there's what we refer to as limited life. There is no, the business doesn't have its own existence separate from Linnea. Right? So this creates, it can create problems. Transfer of the business can be a little more complicated because you have, well, it's a harder to value entity. It is, you are transferring a lot of, how to say this? You are transferring not just, because there's no difference between you and the business, it can be a little more complicated to value the business and then execute the transfer. You'll see why that's easier in a corporation in a minute. And then financing can be problematic because of because there's no difference between you and the business. Some banks will be less likely to lend to you. But this can kind of go both ways, because if there's no difference between you and the business, the bank knows it can automatically come after your other personal assets. So, but typically, you know, financing can be a little more difficult to get as a sole proprietor. Now, sole proprietorship, partnership. A partnership is very much like a sole proprietorship, except there's two or more people involved in the business entity owning it. So Cole and I can shake hands and say, hey, let's start a durable medical equipment company. We're going to start selling, we're going to start selling CPAP machines and crutches and hospital beds to the community. We shake hands and we both contribute some money, and there's some complexity there that we're not going to get into about how is the partnership 60-40 or there's a bunch of stuff to that. But basically all it takes to start a partnership is kind of like all it takes to start a sole proprietorship is, hey, you want to go into business? Yeah, I'd like to go into business. Okay, we're in business. Yay. And that's partnership. Now it's a good idea to write down the agreement, right? And document it and start getting a little more formal. But really all it literally takes to start a partnership is a handshake, even a verbal agreement. Right? So Paul and I say, hey, we'll start a business. Okay, let's do it. Okay, we're in business. Really simple. Again, the big advantages, the pros, fast, easy, right? It typically doesn't require a whole lot of effort. The taxes flow through to your personal return, to personal return. So just like a proprietorship, the income you get from a partnership is treated like ordinary income for you. And so if Cole and I are partners and Cole has more income from some other job and he makes more money than I do, then he's going to pay a higher marginal tax rate than I will, even though we're both making the same amount. Let's say we're 50-50 partners and we're both getting $50,000 a year from the business. if Cole also is making $100,000 from another job that he's doing, and 50,000 is my only income, then he's going to wind up paying a higher marginal rate than I am. So it has nothing, what taxes he pays has nothing to do with what the business is earning. It's all about his total income drives his taxes, right? Just like with a sole proprietorship. Now, there's some differences there that I'm not going to get into, and they're not really important. The key here is, again, that phrase, no double taxation. I want you to keep that in your head. Sole proprietorship, no double taxation, and partnership, no double taxation. Now, the cons of a partnership are basically the same as the cons of a, well, are similar. There is unlimited liability, right, for the partners. So let's use our car accident again, right? Cole and I are in business together. We're selling durable medical equipment. We've got we both have vans, and we take orders and we go out and we drive around and drop off equipment at patients' houses. And one day I'm out driving around and I get into a big accident, right? And maybe it's something really traumatic, and we wind up having $1 million set judgment against us, right? Because I was found to be negligent. Let's say I was totally goofing off, right? I was texting with Tessa again, something like that, right? And I crashed the car and I hurt some people and I wind up with $1 million judgment. They come after the business is worth $300,000. Okay, there's $700,000 left over. I have $100,000 in personal assets. Okay, so they take that. That's $400,000. There's still $600,000 in remaining liability. What happens now? Doing zoom in, I'm pointing at Cole. Cole gets stuck with the $600,000, even though it wasn't his fault. Because I was driving the car. While I was doing business as Cole and Mark's durable medical equipment, company, and so because he's my partner in the business, and I got in the accident while I was doing business as the business, Cole is equally liable as I.
And they can go out after his first, can they only go after what he made from the company, or can they go after what he made for the other job?
They're going to take his Tesla. They're going to take, his cool condo in Portsmouth. They're going to do whatever it takes to pay off that $600,000. If he's got $600K in his bank account, which he might, they'll take that, right? The point is, if you're in a partnership, there's unlimited liability between the partners. That encourages the partners. The plus side of this from a governance perspective, from a citizens looking at business people, is Cole is going to be really concerned about how I drive, right? And likewise, right? We're going to both be kind of watching each other and keeping close tabs on each other, because he's if he misbehaves, I'm liable for his misbehavior. So in a way, having that unlimited liability on partnerships makes the partners really conservative, right? And then they make them, and they, you in some sense. So it used to be like investment banks, so that get into doing they're kind of caused a lot of the financial meltdown we had back in 08, 07, 08. Had a lot of, they used to be partnerships, and then they were allowed to become corporations. And so when they were partnerships, all the partners were liable for the behavior of all the other partners. So they used to be super conservative. And then they became corporations and they had limited liability, which we'll talk about next. And they started kind of doing a lot of stuff that they wouldn't have done when they were partnerships, because back when they were partnerships, if something blew up and something went wrong, all of the partners would be liable for the losses. Now, as corporations, there's limited liability. So if Cole and I are partners, we're going to watch each other's behavior pretty carefully, because we know that, and especially if it's in a high-risk business, which durable medical really isn't. But if Cole drives 100 miles an hour through downtown Durham, we're going to have a conversation, right, about that, because I know I'm liable for his behavior. Okay? So that's a big one in partnership. So like sole proprietorship, at least it's your own fault. With partnership, it's your partner's, if your partner, and if your partner signs an agreement, that makes you liable for something, or buys equipment, or whatever, you're liable for that as a partner. And you can always go to court and fight about it, but if you're a partnership and you don't have clear documentation saying partner A is allowed to do this and partner B is allowed to do this, and all that kind of stuff, that can protect you to some degree. But there is unlimited liability. That's the big thing, right? Transfer of ownership is another. This actually gets more complicated with a partnership or ownership. Let's say Cole and I are running a business, we're partners, and I want to get out, and I want to sell my business to Emma. I want to sell my share. Emma's like, hey, I'll buy your business there, Monica. And Cole says, I don't like Emma. I'm not going to work with her. I can't sell my business to Emma, right? Because we're partners. Because Cole and I are partners. And Cole like, I get into business to go into business with Emma. I don't trust her. Not going to do business with her, right? Not that you would, right? But just saying, he has kind of a veto. I mean, again, it depends on the partnership agreement, but it gets messy when you try. You're like, you know what? I'm old. I want to go retire to the Bahamas. I really want to sell my share of business. There's a lot of personal stuff that has to be worked out because there's really no difference between the business and Cole and me, right? And so it's kind of more like getting into a relationship, right, with a partnership than it is just strictly like business is business. Financing can also be tricky because now you're, now the bank is knows the liability issues, and now it's going to evaluate both you and your partner, right? So financing can also be. Right, so financing can be more difficult. All right, so that's sole proprietorship. Partnership, very similar, kind of classic forms of business. The corporation. Most businesses are incorporated or are corporations. Right? Wentworth Douglas is a corporation. HCA is a corporation, obviously. Most businesses, most large businesses are corporations. If you start a dog walking business, you're not going to incorporate that. This doesn't make any sense. For a lawn business, you're not going to incorporate. Why aren't you going to incorporate? Well, because it's expensive, right? So some of the cons, it's expensive, right? I'm jumping the gun here. Takes more time. You have to get lawyers involved, right? The corporation is a legal person. The corporation is a the corporation is a legal person, right? You've probably heard a lot about that from there was a Supreme Court case relatively recently, Citizens United, affirming the idea that a corporation is a legal person. What does that mean, a legal person? The state, so corporations are state entities. So you incorporate in a state. So you can become a New Hampshire corporation or a Massachusetts corporation or a New York corporation. Believe it or not, there's one state in the United States that is regarded as particularly good with its corporate law. And it's not and most of the large corporations that you would think of are incorporated in that state. Anybody know what that state is? It's not a state you're going to think of, probably. It's not like California or New York. Right? It's not a cool state. Delaware. What do you even do in Delaware? I don't know. You drive through it on your way to New York or something. They do have, I don't know if you guys have ever driven 95, like up north and south. Delaware's got like this, it's kind of like the New Hampshire coastline. There's like 10 miles of Delaware. that you have to drive through in order to get from, I forget, like Maryland to, Jersey or something. And they've got like a $6 toll to get in and like another $6 toll to get out. And I think that's how they fund their entire state revenue. It's basically just like a highway of robbery on I-95. But they're apparently really good at corporate law. Their corporate law is very well developed, right? And so, most large corporations in the United States are actually Delaware-based corporations. Now, they may not actually have their headquarters there, but their legal home is Delaware. So, but you would only do that if you were going to be doing business. Like if you were setting up a DME firm, like Cole and I are gonna, instead of doing a partnership, Cole and I decide, it'd be a good idea to be a corporation just in case, right? Or to simplify transfer or whatever our choices are. We would probably set up in New Hampshire, assuming we were going to do most of our business in New Hampshire or most of our business in, say, New Hampshire and Maine, we'd probably incorporate in New Hampshire just because it's more convenient. If you're a big national firm or international firm like Coca-Cola, right, you're going to have offices in every state, it doesn't matter. So you're going to probably have, you'll go and do your corporation where you're set up your corporation wherever the corporate law is the best managed. In that case, it's Delaware. So Caitlin had asked earlier about sorry, I missed the chat. Caitlin asked if there was a legal agreement for a 50-50 partnership, would they only be liable for 50%? Yes, until you run out of money, right? So, so if it's 50-50 partnership, you split your liabilities 50-50 until there's a bunch of kind of stuff involved there. Like how much of, first we exhaust all the resources. So it could be, it's going to go down a bit of a rabbit hole, but it's possible that Cole and I have, even though we have technically a 50-50 agreement, we could wind up with different stakes in the firm. So I don't want to go there, but yeah, Caitlin, you're kind of generally right. But once the resources and the assets have been exhausted, then it's whoever still has assets would be liable for the rest. Does that make sense? Right. So this is sort of a prenup, right?
Yeah.
But it is not a shield, right? So there is we sort of have this agreement that, but once all my resources were exhausted, they'd still come after Cole. Okay. So corporation, legal person. So we create this legal entity that's a legal person, right? In the sense they can't vote. They're not citizens, so they can't vote or but they can. A corporation, so the officers of the corporation acting as the corporation can buy property, plant, and equipment, right? Wentworth Douglas is a corporation. It can itself own stuff, right? That's probably the biggest thing. It can enter into contracts. So Deborah, as the CFO of Wentworth Douglas someday, could sign a contract on behalf of Wentworth Douglas. So she's acting not as Deborah, but as the agent of Wentworth Douglas. And she can sign a contract with, they have lots and lots of contracts, but they can sign a contract to, build a new hospital, sign a contract for $100 million, right? And Wentworth Douglas would then be, it's not Deborah that's liable on the contract, it is Wentworth Douglas as an entity, right? Could own, and Deborah would just be acting as an agent for the corporation. Right? So as a legal person, the corporation has in particular the ability to own stuff. Right? It is legally separate from the owners. So it is its own person, and it generates its own liability. Yes. It's going to be a pro because it is for a couple of reasons. Number one is because it limits liability. So I would say, I set that as a pro, limited liability. So let me use an example. Cole and I go into business again as a DME firm, and instead of getting into and we're running the business, we've got say $100,000 in assets in the business. We've both contributed to the business. We own it 50-50. Cole owns half, I own half, right? And the business is worth $100,000. Let's say we, instead of getting into an accident, we just make some bad business decisions, and we wind up with $150,000 in liabilities. We bought a bunch of stuff and we couldn't sell it, and now we have $150,000 in liabilities, and we declare bankruptcy, and we decide to go out of business. Our liabilities exceed our assets, and we'll get into what that means in chapter 4. But we have creditors now coming to us saying, hey, where's our $150,000? We're like, hey, you know what? The business is worth $100,000. How about we give you $100,000? And they're like, no, we want $150,000. And Cole and I can say, really sorry that that you have. I feel for you, but we're not going to give you we don't have the $100,000. And they say, well, wait a minute, Cole's got a Tesla in the front parking lot that's worth $100,000. Give us that. Cole says, yeah, a separate entity. You signed a contract with Cole and Mark Incorporated, not with Cole, me, right? So no, you can't have my Tesla. You can have all the stuff that Cole and Mark owns, right, as an entity, but you can't have my personal assets. Okay. And I'm using the example of a business thing rather than a car accident, because that gets messy with well, if you were driving and you were negligent, I'm going to sue you personally as well as a business. So, but if we did something, say we just made bad business decisions, right, that wound up bankrupting the firm, and we wound up with liabilities greater than our assets. When we go bankrupt, we would liquidate the firm. We would have $100,000 in assets, and the bankruptcy judge would pay out in kind of there's a kind of a standard order who gets paid first, but they would pay out the $100,000, and then whoever was owed the 50 is just stuck holding it back. Right? They don't get paid. Okay, and that doesn't matter that Cole has a Tesla and a condo in Portsmouth and $600,000 in bank. It doesn't matter. They can't come after him for the $50,000 because their contract was with the corporation, not with me and Cole as individuals. So it's protected in that sense. You might hear the phrase a corporate shield, right? And that's what that means. It's more protected from unlimited liability. So there's a pro. So that's a big pro. Right, is the entity is a legal person and is legally liable for whatever liabilities the agents engage the corporation. But the individuals are not, the owners are not liable. Another way we could look at this is we could create a corporation. Cole could go into business with his, rich uncle, right? And the rich uncle could contribute $100,000 to the firm. Cole can contribute, $10,000 to the firm, and Cole can contribute $10,000 to the firm. The uncle contributes $90,000 to the firm. Cole is a 10% owner. The uncle is a 90% owner. But the uncle wants nothing to do with the business. He's just lending Cole the money, basically. It's like, I'll take a stake in your business. And then we'll hire you as CEO, right? And you'll pay yourself a salary out of the earnings of the business. And then if it makes any profits, we'll split it 90-10. Right? So if there's excess profits, the profits belong to the owners. We'll get into that a little more there. So Cole pays him. So let's say the business, after they pay Cole $100,000 in salary, the business makes $1 million in profits. $100,000 belongs to Cole, $900,000 belongs to his uncle. So that's That's kind of the beauty of a corporation. The problem is, cause is now double taxation comes into play. So it's not all sunshine, rainbows and sunshine.
Was it transfer pretty easy to like pull the buyout his partner tree?
Exactly,
So, like,
right. So uncle could be like, you know what? I know you don't, Cole, I know you don't like Emma, but I'm gonna sell all my shares to Emma, and now she's gonna be the 90% owner, and you're gonna work for her. And you don't really have any right to say no, right?
the Cole can also buy it.
Cole could buy it, you know, the uncle could sell it to 5 different people, right? Because the ownership is now separate from the entity itself. There's a separation between ownership and the business with a corporation. Now, double taxation. Okay, so let me say pros. Let me finish the pros, and then I'll talk about double taxation. It's a little confusing. Limited liability, unlimited life. Whereas if Cole and I were partners, and I was to get out of the business, or if I was to get run over by a bus, or get run over by Erin when she's driving around in the pizza van, then the business would cease to exist as a entity because I'm no longer a part, right? If Cole's uncle was to, if they were to incorporate, and Cole, the uncle owns 90% of the shares of the business, Cole owns 10% of the shares, and the uncle was to sell his 90% stake to Emma, the business just keeps on going. It doesn't matter who owns it, because there's a separation between the business and the owners, right? And so there's no change in the actual in the business entity as a result of ownership. So the business keeps on going. Cole may not like Emma and want to quit, but that doesn't matter either. The business, whoever is the CEO, doesn't matter either, right? The business is itself its own legal person. It doesn't stop existing. That makes it a little easier for financing. It is also easier to take the business, from someone if you're, so if you are a creditor and the business doesn't pay you, you can take the business from the owner. So it's easier to transfer the business, which is why it's easier to get financing. Let me talk about double taxation. Let's say we have sole proprietorship. We'll go back to Linnea. Linnea makes let's say Linnea makes $100,000 as both a sole proprietorship, so profit. And we'll look at Linnea's Pizza from 2 different perspectives. One as a sole proprietorship, one as a corporation. So Linnea has the foresight to say, I'm going to be hiring people like Erin to drive for me, I better incorporate. So as a sole proprietor, let's say she makes $100,000. That $100,000 in profit, that $100,000 in profit is ordinary income to her, which means it just shows up. She has to file it on her 1040, right, her personal tax return. She files and says, I made $100,000 from the business. Let's say, I don't remember what the tax rate is, the marginal tax rate is for $100,000 today, but let's say it's 30%. She pays her 30%, 30% of 100 is 30K. She's left with $70,000 after taxes. AT after tax, okay? If she is a corporation, and then we're done. That's the beauty of sole proprietorship, right? It flows onto your 1040, right? You put it on your Schedule C, which is where you put business income and expenses, and then you pay your taxes and you're done. So she pays, say, 30% after tax. if she incorporates, Linea's Pizza is now not the same thing as Linea. Linea's Pizza is a separate individual, legal entity, a separate legal individual. And the government taxes corporations separately from their owners. So Linea's Pizza, let's say, is in the 21% tax bracket. It pays 21% of the $100,000 in profit, or $21,000. That leaves the business with $79,000. Now, the business, Linea, as both the sole owner, not the sole proprietor, but the sole shareholder of the business, says, I'm going to pay myself out the $79,000 as a dividend, right? So let's call that a dividend. And a dividend is just a payment from a corporation to the owners. And dividends are typically paid out of profits. So let's say she's going to go ahead and pay herself all of the profits. Unusual, doesn't happen most of the time. But just for simplicity's sake, we're going to say that she's going to pay herself 100% of the profits, the after-tax profits. So she's going to pay herself that $79,000. She now has to pay that $79,000 as a dividend, now shows up on her 1040 as ordinary income. So she now has to file, when she goes to file her taxes for 1040, right? She has to write down dividends earned in the course of the year. So she's going to have to pay the 70. She's going to say, I earned $79,000 in dividends. That's treated as, I believe that's treated as ordinary income still. And so let's say she pays 30% now on the $79,000, which I can't do in my head. Is 23,070.7, which leaves her with 55,300. So the effective tax rate is 100 minus 55.3. Is 44.7, right? So the effective tax rate is on Linea, if she incorporates, is 44%. If she operates as a sole proprietor, the effective tax rate is 30%.
Do you think that difference is less than or greater than insurance?
That's a good question. I would venture it really would depend, right? It would really depend. So we're talking about a super simple business that may or may not incorporate. In fact, I would say most likely they would use a different form. Linea really was starting a pizza delivery business. She would probably not incorporate these days. She'd probably do an LLC, a limited liability corporation, which is a little bit different. It's got aspects of it provides you limited liability as opposed to unlimited liability, but at the same time, it becomes what's called a pass-through organization, which means that the profits pass through, they don't pay corporate tax, it flows directly to you as if it was a sole proprietorship. So there are other ways to do it today. So if you're a super small corporation, you're probably not going to be a C corporation, which is what we're talking about here. You'll probably be an LLC or maybe even an S corp. Again, there's lots of variations. I don't want to, that we're not going to cover in this class. So good question. You would want to talk to your attorney and your accountant to figure out, all right, I'm going to set this thing up. What's the right form for me to do? You want to go to a tax professional to get that advice.
So you can incorporate as a sole proprietor, or do you need to go in with someone to incorporate?
Oh yeah. So you could be a sole owner. You're not a sole proprietor.
Yeah,
So that's a technical, right?
Yeah.
That's a technical. You could be 100% owner.
You're
Of a
one person, but
corporation.
you're legal, so one person can be behind a legal.
Yes. You don't need to have a partner or
You just
co-owners.
separate yourself.
Right. And I don't want to use partners. That's wrong. I don't want to mix right? You don't need to have multiple owners in order to have a corporation. You personally, Emma,
The one person behind the people.
exactly. You can set up your own business and incorporate it, and then, yes.
So the profit from the corporation, if you were to put it, if you were to make it a dividend, and you just had like a business, like credit card or something like that, and you didn't claim it on your own personal account, but you were using this, like, that's legal, right?
That you wouldn't pay it out as a dividend, you would use it.
Yeah, like if you kept it in the corporation and didn't call it your personal income.
Yeah.
Because you.
So what you're describing is called retained earnings. Okay, so name
Jessica?
Jessica. All right, so people in Zoom land, Jessica's asking, what if I didn't pay myself out what if Linnea didn't pay herself out the 79,000? Is that what I'm hearing? But instead hung on to it, used it for other purposes.
Yeah.
That is called retained earnings. And that is, I was saying a minute ago, most businesses don't pay out 100% of their remaining their profits, right? Their after-tax profits. Most of them will retain a majority of that money, actually. And they retain it to buy new equipment, to replace old equipment, to expand the business, right? There's a whole string of reasons why we're doing it. So, and to kind of, I think, answer the implication is, if you don't pay it out as a dividend, then the owners don't pay personal taxes on it.
So the company cards, like if you go into the personal.
Okay, so yes, so instead, if Linnea buys herself a company car, which she drives around and goes to parties there and stuff, yes, so you could shield, so there's all kinds of ways that this is how, my wife is a CPA and she does business returns as well, private returns. And it infuriates her when she sees people, buying the latest iPhone and that's a business expense, right? But she's like, BS, it's not a business expense, And, there's one guy that she wouldn't let him get away with it, but he was like, he and his wife and his kids are all the owners. They're legitimately the owners of the business. And they did a corporate meeting in Egypt, right? And
So like, is there like a legal line for that?
Yes.
Can
you have to be able to prove, that you actually conducted corporate business while you were in Egypt, riding camels and looking at the pyramids.
So does that consist of just like we got together and had a 10-minute meeting, or is there like financials or something?
Like that's our meeting.
You would have to prove, that the primary purpose of going to Egypt and touring the pyramids had a business purpose to it. And if and that would be a pretty solid red flag, as my wife calls it, for the IRS to start. Sorry?
Who would call into question? IRS?
The IRS would. So the IRS has investigators, you file your return, it goes into, they probably have, I think once upon a time there have been humans there, but probably now they've got some sort of algorithm that reviews stuff like, a car dealership in Fort Worth, Texas. She actually works for firms in Fort Worth. Fort Worth, Texas had a business meeting in Egypt. That might warrant a human review. And then a human picks up and says, that's garbage, right? And then you get a letter from the IRS. Please explain what the business purpose of your meeting in Egypt was with your shareholders, and why that was a business expense. And if you can't prove it, there are a range of things that the government can do, from making you restate your earnings to penalties to jail for tax fraud. Right? So it's a no joke. Like you can play around the fringes, buy yourself a fancy iPhone, get a corporate car and maybe use it for personal business. Technically, you're supposed to report, if you have a corporate car, you're supposed to report how many miles did you use it for business, how many miles did you use it for personal, and then you can, you wind up having to, I want to say, I'm not a tax expert, my wife will tell you this, I believe the portion of the expense, so like, let's say you used it 50-50 for personal and business. The 50% of the cost of the car for that year would be a business expense and would be treated as and would reduce the profits of the business. The other 50%, I believe, and and I would need to check with her to verify, would be treated as personal income. I think. Like I said, I'm not a tax expert. But I believe that would be the case, that you would have to then recognize, the value of the car as income from the business. Does that make sense? Yeah. Okay. All right, we're about out of time, so we're gonna stop there, but I'll take one more question.
Actually, I'm sorry. Could you explain to me again what the 44.7% is?
The 44%, right, the effective tax rate of 44% was, she made $100,000 in profit as her corporation. She paid $21,000 in corporate taxes. Right? She then had $79,000 in after-tax profit for the entity. She then, as the sole owner and chair of the board, made a declaration that she was going to pay out all the after-tax profits as a dividend, which is her right to do. When she received it then that dividend becomes ordinary income on her personal tax return, at which point she paid 30% in personal taxes on the $79,000 that she received from the company, leaving her netting $55,300. What I'm saying is she started with 100, she ends with 55. The difference is 44.7. So the effective rate, she wound up paying 44%, 44.7% of her $100,000 as opposed to 30% if she'd been a sole proprietor.
Okay, thank you.
All right, very good, thank you. I guess we'll finish up chapter 1 on Tuesday of next week.